Great. All right. So we'll keep an eye out on that then. Avnish, thanks so much for joining in, giving us those details. Thanks, Mangalam, as well for joining in. Well, that's the HDFC Bank management. They're set to address the press, so I think we'll cut across very, very shortly. But remember, ITC it also enjoys, and what Mangalam has been always telling us, that valuation comfort. If you compare it with the other FMCG companies, they trade at 40, 45 times. I think some of them trade at even 50 times. But ITC, giving a 10 rupee EPS, trades at around 27 times, so it always enjoys that
as
valuation
usual, let me just walk you through some of the key
Bank,
financials.
Let's hop across and hear out what the management has to say.
Head out to the EGM. So for this quarter, net revenues were at 14,183 crores, which was an increase of 23.9% over the corresponding quarter of December 2016. If you look at the breakup of these net revenues, roughly 73% is net interest income and 27% is the other income. Net interest income for the quarter was 10,314 crores, and NII growth was 24.1%. The core net interest margin for the quarter was 4.3%. Other income, which was 27% of net revenues, grew from 3,142 crores to 3,869 crores, and that was a growth of 23.1%. If you look at the breakup of that other income, there are typically four components, and the largest component, which is of that 3,142 of total other income, 2,872 of the 3,314,2206 and of the 3,869,2872 was fees and commissions, and fees and commissions for the quarter on a year-on-year basis grew by 30.1%. Operating expenses for the quarter were 5,732 crores, which represented an increase of 18.4%, and what that meant that the core cost to income ratio was at 41.2% as against 43.8% in the corresponding quarter of last year. So both on the revenue growth side as well as on the cost side, in terms of the cost to income, you've seen that there has been an improvement on a year-on-year basis. Total provisions were at 1,351 crores as against 715.8 crores for the December 2016 quarter, and as against 1,476 crores for the September quarter. So on a sequential basis, they are marginally down. On a year-on-year basis, of course, there is an increase. Moving on, if you look at post-tax, the net profit growth, of course, was 20.1%, and the actual net profit for the quarter was 4,642.6 crores. A couple of the balance sheet items as well. The total balance sheet size as of December 2017 was 9,49,000 crores as against 8,28,000 crores in December of 2016. Total deposits were at 6,99,000 crores, an increase of 10.1% over December 2016. The CASA deposits grew by 6.7% on a year-on-year basis, and however, on a sequential basis, it would be about 3.9%. Remember, both for deposits and for advances, the base is a little distorted because if you remember, December 2016, which was the demonetization quarter, saw a huge spike in deposits while loan growth came off. So you'll find that the loan growth looks particularly strong. Total advances growth at 27.5%, which took the total advances to 6,31,215 crores. However, I think therefore if you look at sequential growth, which might be a little more relevant, the sequential growth in advances was 4.4%, and as I mentioned earlier, the sequential growth in deposits was again at 3.9%. The CASA ratio was at 43.9%. The loan growth itself came equally strongly from both wholesale and retail. The mix today is now 55% retail and 45% wholesale. And again, if you look at it from a regulatory classification in terms of the Basel II classification, then retail loans grew by 28% and wholesale by 26%. If you look at it from a business perspective, our own internal business classification, the growth was 29% retail and 24% wholesale. So either which way, no matter how you cut it, both those businesses have, or both those segments have contributed to the loan growth. For the 9 months, the bank earned a total income of 69,912 crores as against 60,041 crores for the 9 months ended December 2016. Net revenue growth was 22.8% for 9 months, and net profit growth was 20.2% to 12,687 crores. Finally, on network and asset quality, as of December 2017, the bank's distribution network was at 4,734 branches and 12,333 ATMs across 2,672 cities and towns. 52% of these branches are in semi-urban and rural areas. On the asset quality front, gross NPLs were at 1.29% and net NPAs were at 0.4%, and our total capital adequacy based on the Basel III guidelines was at 15.5%, of which Tier 1 was at 13.6%. Those are some of the key financials, and if you have any questions, I'll be happy to take them.
So on the divergence, you've given more data. Last time you had said that there was some discussion about one account. Now you're talking about 3 accounts. So is there a fresh assessment?
No. So of the divergence which was there, first of all, as you know, as of the last quarter, we had mentioned that while there was no finality to that, we had already made contingent provisions. Immediately thereafter, that account had been declared as NPL. Of the balance amount, some had already been declared NPL in the June quarter and the September quarter. So as we stand, I think we have now given the total, since this was a quarter in which this is the first quarter end after the finality to that, we have given the divergence of the total NPLs and of course what the status is on each of these.
Okay. The last account, the account which you had declared in the last quarter where the discussion was going on, other banks are saying that it's paying for a year. So will you write back that provision?
Well, as I've said, if you mentioned that note itself, the account has been upgraded by the JLF itself.
Okay.
As far as provisions are concerned, well, whatever portions of the provisions were floating provisions have gone back to floating, and the rest back to other contingent and general provisions.
Okay.
That's around 17 billion rupees. That's the number.
Yeah, whatever the amount in respect of that would be.
We just want to get a sense, because you spoke about the year ago number not being relevant. Only on lending growth, April, December, what kind of, year to date, what kind of growth have you shown? Also in terms of, because you mentioned the divergent account, what was the criteria on which there were, as in the RBI spotted divergence? Is it because it was standard with you and not with somebody else? Is it because there was some decision making at a group level that was not happening? We just trying to get a sense of it, because generally you've not had divergences when it comes to.
So I think this is again something which we had partially explained last time as well. This was an account which was subject to the flexible structuring under the 525 framework, and in respect of that, the supervisory communication was that they felt that was not sort of meeting all the regulatory guidelines, and therefore that flexible structuring amounted to restructuring, and which therefore declared an NPA. From a servicing perspective, the account had not been past 90 days, which was the accounting reality.
Also, the bank is looking
also on the loan growth.
Sorry, yeah, on the loan growth piece. See, I think all I'm saying is that because of that distortion, which of course corrected itself along the way, just the number seems inflated. But if you look at it in terms of the absolute growth that we've seen for the last 3 quarters, we've still seen very strong growth, and you'll find that the corrected year-on-year growth will be reflected if you look at just the September quarter or hopefully the March quarter as well. It's just that this particular quarter, because you had that flow, and by the time you had the March quarter, some of the spike in deposits had normalized, or at least some part of that. And again, that part of the loans, that part of it which had come down because people had prepaid or repaid their cash into their, the SME lending and the business banking lending, that got corrected along the way. So I would still say that if you look at the last couple of quarters, we've had most of the businesses growing their loan book somewhere in the high teens or low 20s, and I think this distortion is just a little bit of a base effect. But sequential momentum again at 4-ish% is still 4.5% is pretty strong.
So at the beginning of the year when you met investors, you had indicated about 20 to 23%. Is that somewhere where you landed?
I don't think we've ever mentioned a number. We have traditionally said that we would grow at a certain pace which is ahead of the system, and we had also felt that the system which was growing at at that point of time in single digits was probably artificially muted. We have seen in more recent times that the system growth itself has now picked up to closer to 11%, which incidentally was what I thought is an appropriate system growth rate given what we were looking at in terms of GDP growth. So if you then correct for these aberrations, we are still clearly growing significantly higher than the system, a little more than the traditional 4 to 7%, but that's clearly a function of the kind of market share gains that we've had in the last couple of quarters.
Is it because you're refinancing other loans? I'm sorry.
I think a large part of the growth has come from retail, where the business itself is growing, and we are a market leader across products. And some of it, of course, on the wholesale side, both large and mid-sized corporates as well as SME, is where we've been growing at a pace faster than the system.
Where was the growth on wholesale and even on retail? How much is the answer?
Well, on the wholesale, as I said, both corporate banking and ECG, which is our emerging corporates group, has grown well. The business banking piece, which is a little more of the SME, has grown slightly slower than that, but has continued to grow. Both these pieces have continued to grow, and you see growth rates of somewhere in the low 20s to mid 20s across different segments. So it's really a matter of relative rates of growth rather than one growing and the other not growing. On the retail side, we've had actually the fastest growing pieces, given the sheer size of those portfolios in this quarter, has been auto, commercial vehicles. Personal loans, credit cards has also grown, but in absolute terms, they are slightly smaller portfolios.
So far, banks that have reported numbers are seeing healthy growth in the corporate segment. You have about 45% exposure to the corporate segment. Are you looking to rebalance the portfolio to increase your exposure towards the wholesale side? Is that on your agenda?
So from our point of view, we are pretty indifferent and agnostic about whether we grow faster in retail or wholesale. We believe we are equally well positioned in both these segments. So the actual growth rates that we deliver are a function of the underlying demand. Right now, given that a large part of the economy is being driven by consumption demand, clearly the retail part has seen strong underlying demand, whether it's for car sales and truck sales and so on, which then drives those particular retail loans. On the wholesale side, it's been driven a little more by some amount of working capital, some amount of mid-tenor loans, medium tenor loans, and some refinancing. Over the next couple of years, if we see a heightened pickup on the capex side, on the investment cycle, it's quite likely that you'll see a further pickup in the wholesale book as well. But honestly, whether it's 45-55, 50-50, or the other way around, 45-55, we are absolutely fine as long as there is that much of underlying growth. From a risk-reward perspective, it fits into our appetite. And of course, given how rates and the competitive environment is shaping up.
Also, the bank is looking to raise close to 24,000 crores. Could you broadly indicate areas where you would be utilizing the funds raised?
Well, clearly, if you look at the pace at which we are growing, we have been consuming capital, and that's evident even in the last few quarters. So the capital that we are raising is to support growth for the next few years. Clearly, the threshold of what is acceptable from a tier 1 perspective for a bank like us, we believe is slightly higher when you factor in the growth for the next few years. I think the growth, this is not capital allocated for business 1 or business 2. We believe we have multiple engines of growth, and this should support that growth for the next few years.
What is the outlook on lending rates?
Well, right now, given in particular liquidity conditions and the fact that even at a system level, loan growth for the first time now is outpacing deposit growth quite sharply. I think if anything, either rates will be in for a bit of a pause, or if these liquidity conditions remain the way they are, there could be some upward pressure on both deposit and lending rates.
One of your accounts under diversion, was because of the technicality of the 525 that was implemented. Now, I just wanted to get your comment because there are several 525 accounts where you think now, from what we understand, the regulators be looking into and it could be open. Is there further scope for it?
We have no such visibility, and I think this was specific to the facts and the circumstances for that, but relating to the structure of the flexible structuring.
So have you revised your MCLR? And
we haven't as yet. The last MCLR, which was as of 7th of January, has remained more or less the same.
is there a likelihood of it?
See, the change in the MCLR is a function of what happens to deposit rates, especially for those tenors where we get a large part of our deposit inflows. So at this point of time, unless we have a change in our deposit rates between now and the 6th of February, it's tough for me to try and predict. But it's a set formula. So depending on how deposit rates move, you'll see a change in lending rates. So far, I think it's been fairly stable, but the percentage of different tenor buckets is also very relevant.
So the provision of falling sequentially, right? The NPAs have been there probably just
Yeah, so the total provisions are a function of both specific and general and contingent. As we know, we had already made some provisions last time for contingent and so on, some of which have of course been also made into other general and floating provisions. So our coverage ratio, as you can see, has remained very stable. It's the same at 66.3%. So essentially the provisions are appropriate to the level of NPLs at the same coverage ratio level.
have you used some of the contingent provisions?
No, we haven't. As I said, the contingent provisions which were made for last quarter are no longer required for that particular account. Some of those contingent provisions had been made from floating provisions which would then revert. We don't take them back into P&L. And the rest of it between general provisions and other contingent provisions for our agri portfolio have remained more or less the same. So we haven't had a net reversal if you look at it. No, we haven't used floating provisions.
So is there any specific sector in the portfolio where you are seeing stress, and what is the sense that you are getting when you are looking at the estimate to?
So more than we haven't seen a meaningful movement in our SMA 2s or specific segment from our wholesale book. But if I look at the last 3-4 quarters and including this quarter a bit, the segment which has shown an increase has been agri, and I think we haven't necessarily seen the end of that pain. Although you sort of tend to have every alternate quarter a bit of a pullback or a bit of a slippage depending on how the collections from the for the farmer has been from the crop realizations. But on the industrial side or on the corporate side, I don't think we've seen any specific trend in an industry or a segment.